Hi, and welcome to an early global view this morning on Thursday, March 17th, 2016. It is currently 7:45 a.m., coming to you a little bit later than usual because we wanted to make sure we saw the Bank of England announcement. That was at 7 a.m. Central Time, and also the U.S. data that once again was a bit weaker than expected. But the most important influences this week, the reason we're waiting for the Bank of England, were the central banks. We had the Bank of Japan on Tuesday, which was quite dovish but did not ease any further. The FOMC that seemed to lose some of its normalcy bias. If you want more on that, go back to our December 16th post-FOMC meeting post. But they cut the number of rate increases expected this year from 4 to 2. This puts them more in line with the reality of the drags on the U.S. economy from global economic weakness. And again, this morning, we had the Bank of England. And the next thing we ask is, what does all this actually mean to the markets? Well, we've switched over to the June contracts now on the equities and on the fixed income. So fully switched over. So here we are with the June S&P, was trading at about $10 discount to the March S&P, and March S&P, of course, expires today. And on current form, this is off about $4 down around the 2013 level. Now that's very important because even though the March S&P at its premium at the highs pushed up to 2031 yesterday after the FOMC, it only left the June contract stalling once again into the top end of 2010 to 2020. Now, if this market can push out further above that, that's fine. The next lead contract, the front month resistance, is up into 2035. So that might mean quite a bit of further strength. But if it has trouble at 2020, especially if it lapses back below 2010, which you can see is some pretty important congestion right around that area on the June contract as well. The lower front month interim supports are down at 1996, which is, 1995, which is of course a very important level in the June contract as well. That fits right in. And 1986, right around there, is kind of an important level as well. But the bigger, lower support, if this market comes under pressure, the front month support is down around 1975 to 70. And lo and behold, out into next week, we get this channel support, this Fibonacci retracement based on the current high of the June contract coming in right in the 1970 to 75 area, reinforcing its importance. And that's the other important part about the market being lower today, which is the short term, the hourly and 30-minute MACDs did leak out just above their upper runaway bands on the strength yesterday. But if these markets should start to weaken, and they're again off this morning, we'll see if they weaken further, this attempt to turn into an upside runaway, or at least develop more upside momentum, would abort, and that would be further grounds for thinking these markets could come back under pressure. I'm just going to adjust these scales for a moment. And that's pretty much it for the short-term view of the S&P 500.